Get ready to get your questions answered by financial advisors. Learn how to put more money back in your pockets regardless of where you're starting your financial journey with your host, Hannah Mitria. Welcome back, everybody, to Virtual U.S. Financial Advisors podcast. I am super excited to have Jim Barnash here with us. Jim is the president of J.A. Barnash and Associates. He's a financial planner, tax professional, and providing individuals with a solid plan to achieve financial well-being. Welcome to the show, Jim.
Thanks, Hannah. Nice to be with you.
Yeah, so I'm super excited. I know, we've talked previously, and I really love that we have the financial piece playing in with the tax piece of it, but kind of share a little bit more about you, how you got into financial planning and tax planning, and how it all kind of came together for you.
Sure. So I kind of stumbled into things coming out of college. My girlfriend's sister's boyfriend had a friend who was in the insurance business and recruited me right out of college at DePaul University. So I started in the insurance business way back in the late 1970s. And it took me about 3 years, but I figured out that whole life insurance was not the answer to everybody's financial questions. So I got involved with the financial planning program and took the certified financial planner courses, set up my own financial planning practice. And through the course of time, taught the CFP courses, got recruited into some large firms where I recruited, trained, and developed financial planners for those firms. And then as I went through time and my family grew, my daughter decided to start giving me grandkids, and I was traveling a lot. And so the grandkids did not know who Papa was. So I decided to get off the road and set up my practice again. But what I had learned through the course of my time with these larger firms was that, there's a lot of people call themselves financial planners, a lot of people saying they're investment advisors, but really an area that was a gap where people were just going to their accountants or their CPAs to get their tax work done. And oftentimes there was a gap then between tax work and the rest of their financial plan. So when I came back out and started up my new practice again back in 2016, I incorporated taxes into that practice. Mm-hmm. And so my wife and I bought a franchise, a tax franchise, and not so much to do the tax preparation, although it does certainly help us to get in front of people, but more for the tax planning. So if I were asking people, hey, I could use a financial plan, what about you? Oh, no. They would say my accountant does that, my insurance agent does that, the app on my phone does that. But if I asked them about tax planning, everybody was interested. And so that's just one part of a financial plan, but it really led into the ability to talk to people and connect all those elements for them through a side door, if you will. Yeah. So that's what we've been doing for the last 7 years. And it's been a nice way to get in front of people. And it provides us a little bit of leverage that not they can't get from a lot of other financial planners.
Yeah, and I think it's really cool that you got a franchise in the tax side of it to really understand that even more. And I think so many people probably say, yeah, I have a CPA, they do my taxes too, but they're not tax planners. I think there's a difference between a CPA that just does your taxes and a tax preparationer versus a tax planner. And so I really like that you're there kind of helping them through that process to understand, hey, let's plan this for your year to, minimize this. You're only paying what's really necessary, since there are so many, I can only imagine how big the book on tax law is and how many books there are. And so to have somebody like you that's an expert in that, I think is super valuable for anyone that is, wanting to kind of save for their retirement, to just be able to spend their money more efficiently. And so I think that's really awesome that you did that. And then also congratulations on the grandkids. I'm glad you're back home with them.
Well, thank you, Hannah. Yeah, a lot of the feedback that we get when we pick up, obviously people have had their taxes done for years. It might have been from a friend or a relative or a CPA. And what they tell us is that what they're getting from us that they didn't get before was the advice piece, right? So it's one thing to do the taxes and say you get a refund or you owe, but it's another thing to have somebody come and say, here, let me show you some ways where you can reduce your current taxation, and better yet, to introduce that concept of tax planning, which is tax preparation is historical, right? It's already happened.
Mhm.
Tax planning is futuristic, right? So we're talking about how do you change the future? What are the things that you can do? If I can, Hannah, may I share some slides with you?
Yeah, definitely. Please do.
So this first slide that we have here, just a little saying that I like to use because everybody could handle their taxes like Bill Gates or Elon Musk or just about any person of great wealth. The difference is that if you don't know that what exists in the tax code, that's hard to take advantage of it. So this is a picture of Virginia and Washington, D.C. over the Potomac. And there are two bridges there. And the big bridge is a toll bridge. And that's what most
Yeah.
people use because a lot of people don't know that a couple miles down the river, there's just a regular bridge that goes over and you don't have to pay a toll. It's a little bit further maybe to get into downtown DC. But if you know it's there, you can save on the tolls going across. So the quote that I love is, for my tax evasion, I should be punished. But for my tax avoidance, I should be commended. And so
Mhm.
what we really like to do with people is help them to understand where there are opportunities for them to control the tax levers. So we believe that tax planning is part of the comprehensive financial planning. And so when you're making decisions in any area, it impacts all these other components. So whether it's your protection, your accumulation, your transition, distribution, transfer, all of those things tie together. And taxes allow you then to, the old saying is, it's not what you make, but what you keep.
Mhm.
And so what we're trying to do is help people understand how that they can keep more of what they've got and put them in control of the tax levers, right? So,
Mhm.
so our tax planning really begins with that. And then something you and I have talked about is it's a simple concept. It's pretty easy. Everybody's had a bucket that they've used to wash a car or wash a window or to maybe play a kid's game like Bozo Buckets or something. So to understand buckets is something I use because there's three categories of income that you've got. So you've got taxable income, which is non-qualified. Those are things like dividends and capital gains and rents and royalties and your paycheck. So the taxes get paid on those, but on the gains portion, there are lower taxes that get paid on things like long-term capital gains and things of that nature. Then the middle bucket is one almost everybody uses, and I believe they aren't educated enough to know that they're overusing it. That's the
Mhm.
tax deferred component. So that bucket is really your 401k or your 403b pension money. It's IRAs. It's all that deferred money. So it's great when you're young and you're raising a family, you get to take home or keep more money out of your paycheck and save at the same time.
Mhm.
But when that money ends up in your the only money you have in your wallet at retirement, you're paying taxes on those as just like if it was a paycheck. And then when you get to RMD age, which is now 73, the IRS gives you it's a formula and it tells you how much money you've got to take, whether you need it or not. And that
Mhm.
can bump you into higher tax brackets. It can mess with your Medicare premiums. It can pull your Social Security into being more taxable than it might have already been. So it really turns into a double-edged sword in the later years. And then third bucket, more prevalent these days since the Congress introduced the Roth IRA. So that's tax-free money. And it's not
Mhm.
only Roth money, it could be certain municipal bonds, depending on the state that you're in. They could be duly tax-free, but it's the cash value of life insurance as well. So that can be used to create a tax-free, a quasi-tax-free income. So ideally, if I can get to people early enough, I help them to create these three buckets
Mhm.
because this then allows them that freedom. A lot of people I talk to retire at 62. Well, they're not eligible for Medicare till 65. So
Mhm.
they've got to go to the marketplace and buy health insurance. And that's
Yeah.
all based on how much money you make. Because if you make a lot of money, you get no subsidy and the premiums are pretty high. But
Mhm.
if you don't have a lot of income, you get a subsidy from the government. And so a lot of people we know are paying $10, $15 a month, and they're quite well to do, but they don't show any income on their taxes because they're using Roth money. They're using non-qualified money. So that puts them in a great place. So it's as a planning tool, these three buckets, I believe, are essential for people to be able to drive home, if you will, the best results that they can get.
Okay. Yeah. I know Roth's a big thing. So coming into like the tax-free income. And how does somebody like get started with like understanding it? Is it really just coming to something that does tax planning, or is there something they can be doing kind of like right now to kind of start looking at how do I move these money in these places?
So the number of answers to that question, many companies now have begun to offer an option of Roth 401k contributions.
Okay.
So that's a great way. And if you've got a really good company in process, they'll even allow you to split, put some of your money into the traditional side, some of your money into the Roth side. If you've been around for a while, I'm working right now with a couple where he's more towards the end of his career. So we're putting all of his contributions into the Roth side to help him catch up and fill that bucket a little bit more.
Yeah.
So that's a great, easy way to start. If you're a little bit older, and let's say you've changed jobs a couple of times and you got a rollover IRA or two, or you've been contributing to an IRA, then you can do Roth conversions.
Mm-hmm.
Roth conversions, now you're going to pay more taxes today than you would have to if you didn't do these. But currently we're under the tax code changes that happened in 2018. So the brackets themselves were changed, the tax brackets, the marginal brackets, as well as the income levels in those brackets were increased significantly. So it's a great time to be able to do those conversions at lower tax rates than were prior, and may be, since those tax code changes expire unless something is done by Congress, December 31st of 2025. So Roth conversions are a big tool, right? So you'll pay extra taxes today, but when you start getting RMDs, they're lower, so you save taxes there. Higher tax rates probably in the future, you'll save tax there. And the growth, the tax-free growth of that Roth money certainly allows. So in my calculations, 8 to 12 years can be a break-even point there. And it's certainly well worthwhile then in the future. That can also be a great estate planning tool, passing money on to the next generation tax-free for a period of about 10 years. But you can also do, just like you can IRA contributions, if you don't have qualified plan, you can do Roth contributions too. So $6,500 a year. If you're old enough, you can do the $1,000 catch-up. So several ways to be able to do the Roth.
Right. Two questions. One of them, start with one, because I know I always get into two question mode. You mentioned with a Roth IRA, or no, you can have a Roth 401k in the regular 401k some companies are introducing, and you can split it. And I know with a Roth, you can only, I think it's $6,500 a year that you can put into it.
On a direct contribution basis. But if you do it through your work plan, it's the same contribution limits as the traditional 401k. So I believe this year is, maybe that's with the catch-up, but it's about $30,000.
Okay. Is there any reason you wouldn't want to put it all just in the Roth 401k? Like, because you mentioned splitting it. So why split it?
So it really comes down to where your personal situation is at. So if you put it all to the Roth, your taxes that year coming out of your paycheck are going to be significantly higher than when you were doing through the traditional 401k. So it could be a tax decision right now. I've got 3 little kids, we've got daycare issues. I need that money at home. So there is no right or wrong answer there. The answer is what fits your situation. Somebody else who doesn't have any kids, I see little downside to doing all Roth, because as we know, as we look at the debt that our country has, and we see the aging of the population, it's pretty clear that taxes are going to have to go up in the future. And so paying lower taxes now, putting aside money that will be tax-free, that I can use tax-free, and I can use the growth from that. After 5 years, I can use that tax-free as well. Gives me a lot of flexibility anytime I need to take money as to, do I want to, if I'm taking money out of a IRA or 401k, I'm taking the money that I want plus maybe 18, 20, 22, 25% on top of that to pay the taxes.
Mhm. Okay. So yeah, so you're paying just more money when it goes in Roth because you're paying for the taxes now versus putting it in 401k. It's money that's untaxed now, but taxed when you pull it out as an income. And then
Right.
are you seeing companies matching a Roth 401k like they do traditional?
The current law technically says that they cannot match the Roth, that their contribution, now you could put all your money to the Roth, their contribution is going to go in on a traditional basis. For the company, it's a tax write-off. They
Yes.
don't want to give that up, right? So if they're giving you money in the Roth, they don't get a write-off. They're paying taxes on it too. So they want to continue to contribute to the traditional side, and that's okay. I mean, I'm a big believer, Hannah, into building flexibility into all strategies.
Mhm.
So you don't want to put all your money in one investment. You want to put all your plans into one strategy. So having the three buckets is a good thing, right? And
Mhm.
so saving some taxes now isn't a bad thing,
Oh,
but you don't want to do it to the detriment of your future. And that's why even keeping some money, maybe not even doing the Roth side, but starting a brokerage account, right?
mhm.
So you save some money in the bank, you get the money market, CDs, things of that nature. You build your emergency opportunity fund out of that. But getting a brokerage account where you can have some investments that, maybe you buy some stocks, you hold them for a long time. If you need some money, you sell those and you pay taxes on the capital gains. Or maybe they don't do so well and you sell them and you can use the loss against your taxes. So those three buckets really are all important to have. Just having any two of the three doesn't work as well as having all three.
Mhm. So it makes sense that the companies are still like, want to do it the traditional route. It doesn't like they would have to pay taxes on that. So are they matching into the traditional for them?
Yes. So
Okay.
even if I do 100% of my contributions to the Roth, I'll still have a traditional account that will receive the match from the company.
Okay. I think that's really a neat thing that's happening. It's creating two of those buckets for you right there.
Yes.
With one coming from your company, one from you. And then my other question was from earlier, you mentioned you have a client that is, kind of looking at this, like, how do I catch up? And so that comes down to time. Like, when is it kind of like, hey, you're kind of pushing the limit on making sure you have a good retirement if you're not planning already at this point?
The window has widened in recent time because as the required minimum distributions have moved back from 70.5 to 72 to now 73, and until you start getting to have to take your RMDs, you still have time, right? You still have a window of time to do that. The Roth conversions are large sums, so there's no limitation on how much you can convert like there is on how much you can contribute.
Mhm.
So, but you should pay the taxes on those conversions out of bucket number one, right? The non-qualified money, your savings account, your brokerage account, because that gives you the most efficiency in regards to that tax strategy. So ideally, it's catching people early in their career. So I have clients that are young couples, and that's what we've started out now. They're making a lot of money right now, so we are doing the part traditional, part Roth components for them, so that they're filling their three buckets as we speak, right? So they have brokerage accounts as well. So they're going to be in great shape. When I catch people in their late 50s, early 60s, the window's shorter. The decisions, I have a little bit more impact to them.
Mhm.
So if I'm going to convert $25,000 a year for the next 8 years, $200,000 into a Roth, I'll be paying taxes on that additional money. And if I'm still working, it's a potential challenge on the tax side.
Mhm.
So when we're doing the planning part, so there are marginal tax brackets which are set by the IRS, right? So everybody starts out paying 10% on their first $10,000, $12,000. Then the brackets increase gradually. And you're paying, your marginal brackets are the dollars amount of tax that you're paying on the last dollars that you earn. right?
Mhm.
Then you what you've got is really the tax that you're paying is your effective rate. The effective rate is, okay, how much did I really pay? So let's say you end up in a 22% tax bracket, but because of your deductions and things of that nature, you're paying 18%. So
Mhm.
18 cents on every dollar versus 22 cents. When we're doing planning, what we want to do is we start with that marginal bracket and we want to keep you in the marginal bracket, right? We
Yeah.
don't want to have you bracket jump because now we're compounding the tax issue that you wouldn't have had.
Mhm.
So you stretch it out over a period of time and you do the best you can. I mean, ideally, in my world, if I could get everybody to have a third of their income or their assets in each one of those buckets, they're in complete control. But it's not always doable. So we do the
Mhm.
best we can. This couple we're working with now, they have 79% of their money in their middle bucket, the tax deferred bucket.
Mhm.
So the best we're going to try to do is be able to knock that down to maybe 60, maybe 57%, and increase the tax free and the brokerage account money to give them some leverage there. But it won't be perfect.
Mhm. Because with it all being in that tax deferred bucket, that means whenever they do retire, they're still having to pay taxes on all the income that's coming to them.
Correct. And they're taxed at different rates. So when you're pulling Roth money, there is no tax. There's a way to tap into cash value life insurance through borrowing out your cash value. Loans are not taxable. Catch is you have to make sure that policy lasts as long as you do. On the day you die, that policy has to be in place so it wipes out the loans. Otherwise, it becomes fully taxable. So little tricks and things of that nature that are in these strategies.
Yeah. And then I know we're talking about broker. And so kind of explain, what does that look like? How do they get one of those set up? Just so anybody that's listening can kind of really understand, how would they set up a broker account for themselves?
So a number of ways to do it. So there's a number of online brokerage firms that they can set up their own account and make they can pick stocks, mutual funds, exchange traded funds,
Mhm.
bonds, pretty much just about anything. And so they can do that themselves through an online account. They can use a Charles Schwab to do that, a Fidelity, Vanguard. All those companies have the ability to set up your own brokerage firm. They can go through their financial planner if they have a planner to do that.
Mhm.
Um, obviously, I'm a little prejudiced because I think when we go back to that earlier slide when we talked about planning being comprehensive,
Mhm.
a lot of times when I'm interviewing a prospective new client, and what I see is between their 401k, their IRAs, and their outside brokerage money, they own all the same stuff.
Mhm.
That's not diversification, right? So they're not helping themselves, and it's the fact that they're not professionals, right? So they're not taking into fact that if I buy these actively managed funds, uh, what are the things that the managers are buying? And a lot of money managers basically buy the S&P 500, right? And then they add in a few things, or they increase the holdings on a certain couple of the stocks that are in there, but they have an index fund. So it is really knowing that you can have 7 or 8, 9, 10 different accounts. That's great, but they should be managed as one portfolio. So you're killing the excess overlap, you're killing the redundancies, you're not paying for lack of diversification or active management that's really not active management, things of that nature. So of course, being a planner, I lean towards getting somebody in your corner that can help you. The extra return that they should get you and the reduction in taxes that they should be able to get you should be well worth their fee and more.
Yeah. So one thing that's like kind of coming up, and I think having a financial planner, someone that is in your corner, really helping you specifically, because each one of us are so unique as human beings that we need those different directions, because we have different expenses. Some have children, some don't have children, some have plans to travel. But growing up, I feel like we were told, have a 401k, you can retire well. It's not true. Like, well, it can be true, but it's not like that's not the end all be all. You need a little bit more planning involved in it because, like you said, we're all just banking on the same things to keep going well. But our world shifts so quickly. Like, the internet was barely taking off probably when 401k started existing. And so, how do you help somebody shift out of that mindset of hire a financial planner to get beyond just the 401k mindset of that'll be good enough for retirement? Because with the cost of living increasing so much, it might not be enough. And, you want to live a life that's enjoyable when you're retired, not a life of, scarcity your whole life.
Those are very wise words, Hannah. And that's the hardest piece to get across to people, because they do, through reading and listening to the pundits and the experts, they become hardened into these beliefs that you don't need professional advice. You don't need somebody to show you how to do it. It's easy. Just buy a bunch of stocks and you'll be great, or plug all your money into your 401k and you'll be great. And then they quit a job and they're between jobs. And so they don't leave the money in the 401k. They don't roll it to an IRA. They take it out. They pay the taxes, they pay the penalty, and then they're starting over again. So the old analogy on a 401k is it's like a snowball going down the hill, right? So it starts out real small, and as it rolls, it gathers snow, and every time it gathers snow, the next go round, that amount of snow on that increases exponentially, right?
Yeah.
But then when you have taxes, it's like all of a sudden there's a rock in the path that you didn't see, and it takes a big chunk out of that snowball. And then you got to replace that chunk over the course of time. And what isn't preached a lot is the fact about having a diversified portfolio. A lot of people take these target date funds. They were created for a reason, to get people in so they didn't have to worry about making decisions. The challenge is that they're like an index fund that is controlled by your age and not much else. So they reduce the volatility by selling out the stocks or equity portion and adding bonds. Well, up until last year, bonds had the worst 15 plus years of their lives, right? They were worthless pretty much. Interest rates had sunk into as low as they could get, and you made no money on bonds. And so these target date funds were loading up on stuff that was pretty much, you better put money under the mattress in your bed. So how are they supposed to know that, right? And the owners of the companies who run the 401ks. So the company gives them 700 funds to choose from. It's not their job. They have no idea what's a good fund. So they're picking off of star-rated funds or ones that get a lot of pluses or whatnot. Doesn't mean that they're good. Doesn't mean that they're different from the other funds. So the role of professional advice in our financial system is sadly lacking the confidence and respect that it should get. There's a lot of people in the business that are there just for the money, but there's a lot of folks like myself who've been around for 40 years and who've done it the right way. All right. So my main goal in working with people is I want to give you, as you alluded to, Hannah, peace of mind. When you retire, have fun with your grandkids. Enjoy the things that you were planning on doing. Don't be worrying about, oh my God, the market's down. What am I going to do? A professional planner, a professional advisor can give you the guidance to set up your portfolio so that 3, 4, 5 years, you don't have any volatility, right? That's your paycheck for retirement. And then you've got money that's tied up in the, let's just meet the markets, right? So we don't have to beat them. We can choose index funds. They're very inexpensive, and we just want to match what they do. And then the third bucket is your longevity bucket. That's where you want to grow your money so that you're beating inflation. If you live to be 130, congratulations, but you still got money. But that takes some expertise. Very hard to set it up on your own. No matter what articles you're reading, what app you've got, there are always pieces that you're not getting to, the tax pieces. I want to leave money to my kids. How do I gift money to my kids? all these little extra components that are in there that don't get talked about in the apps or the articles that you're reading. It takes somebody who's got the experience and the knowledge and is willing to help you share that. And again, let's put it together as one, not little fragments.
Yeah. And I think that's like really well said. Just there's things that we need help with. And it's any industry. Like I do marketing, and the majority of business owners probably need to hire a marketer. There's a small percentage that can really do it on their own. Finance, the majority of us need to hire a financial planner of some sort. There is going to be a small portion of us that, yes, are going to get super dedicated and figure it out. And I think that's really what we need to look at, is kind of the majority of us aren't going to be tax planners or financial planners, because there's so much to learn and there's so many ways. And I feel like there's so many new strategies constantly coming out. Like you mentioned, there was the tax code in 2018 that was just changed and it's going to expire in 2025. How would a normal person just know that? We wouldn't, because that's not our expertise. And so I think anyone that's listening, if you don't have a tax planner, reach out to Jim to kind of figure out what is that next step and if that makes sense for you. But I think, everything you've talked about today has really made sense and kind of like opened up my eyes and like made my wheels turn of how we're even looking at finances and how, us as a country really should start looking at it more and not just counting on what we've learned from the past.
And Hannah, you're so absolute spot on with that. So everybody has their own skill sets, things that they're good at, things that they like. So you're in marketing. That's a whole different animal. For people in my business all the time are hiring marketers left and right, because what we know to do is great financial planning. We don't know how to get in front of people to tell our story, right? So we need somebody that can do that. People that are actors, that's a skill set unto itself. So they have the ability to get on stage and perform and show themselves as different characters and all, and they're very believable. I can't do that.
No, could you imagine us on stage being actors?
So people should not be afraid of going to a financial planner. There's plenty of things to research so you can find out about people. Obviously, there's a trust component because it's your money. And so maybe you want a big firm. Some people like that because they think there's protection. But, we've had a number of large, especially the bank firms, that have gotten into trouble because there's a greed element even on that side. So maybe you want a small firm or somebody bigger than me, or just a guy like me who I work for me and I work for you, right? So it's a very small relationship. There's only the two involved, but it is just about saying it's okay to ask for help, and different planners work in different ways. Some don't manage money. Some don't handle insurance. Some don't do taxes, but they'll do a simple retainer-based financial plan for you. So at least have that get done for you.
Yeah. And I think one thing to note, like, to work with you, Jim, you are, it's you. You're not some huge firm with, 30 associates under you. However, you're still certified and you still have the accreditations, and you have to go through very similar compliance that some of these big firms go through. And so I want to make sure everyone listening is like, oh, well, do I want to go to a person or a firm? No, you still are a firm. You still have all those accreditations the big people have. It's
Right.
just you're being able to be more personalized with each individual because you're not managing 30 associates and things like that.
And I'm not trying to handle 100,000 people, right?
Yeah.
So, it's simple for me. I've been around a long time, had a lot of nice opportunity and success. I'm at a stage where I work with people that I want to work with, right?
Yeah.
So if I like them, they like me, and we can agree to, how we're going to do this, then it's great. We'll have a lot of fun doing it. We'll get to know each other. It won't seem like anything other than two friends having a conversation, and one knows a little bit more about something than the other. We'll get to know each other's families and likes and dislikes and all kinds of fun things to do. But, there are some people that feel better being a small fish in a big pond, and that's okay too. There's nothing wrong with any of these. They're all good for somebody. Kodak at one time, obviously it's no longer that way anymore, but they had 300, 400 different types of film.
Mm-hmm.
I used their 400 speed because it was idiot proof, right? You put it in the camera and it did everything pretty much for you. My daughter, she used black and white film. She used 100 speed. She used 1,000 speed. She was a camera buff. She knew how to use those films and what value came out of them. They're both right, right? One was right for me, one was right for her. So same way here. It is find who you can provide what you're looking for, and just pay them a fair wage, right? It's right. They're working hard. Everybody wants to get paid for what they do. And I think that really the cost of the advice business for finances is come way, way down. And it's very, very realistic these days and well worth it.
And as we wrap up here, tell us, Jim, who is that person, that should reach out to you? What does that look like? And what is the process to get connected to you?
So I'm going to go back for a second to share.
Yeah.
The tax planning basics that I talk about, Hannah, these are the types of things that we need to do that for people. So we're just going to go over the tax basics for them, planning ages. There are certain ages where things change in the tax bracket. So I can pull from a pension at age 55 without a penalty in certain circumstances. At 59 and a half, I can take from a retirement account without a penalty. Your marginal brackets, I touched on a little bit earlier, Social Security and the compounding effects on that when you're taking that while you're still working, there's tax issues. Pulling it too early, there's losses in income, RMD tax bracket creep, various asset classes getting taxed. And always we talk to couples. It's a big hit when you're married filing jointly, and then all of a sudden you lose a spouse and you're filing single. Basically your deductions cut in half, and therefore your taxes double. So these are the type of things that we look to gather from people.
Yeah, I was gonna make sure. Were you sharing your screen with us? Because we're not seeing it yet.
Oh, I'm sorry.
It's okay. Trying to make sure.
Is it up there now?
Now I see it. There you go.
Okay, I apologize.
That's okay.
So yeah, again, here are the things that we'll take people through on those basics.
Mm-hmm.
And we talk about the future. We get you prepared for what happens when my spouse dies. One of us is going to go, usually first, and then there are some big tax implications, and we want to make sure people have no surprises.
Yeah.
And then you want to get in touch with me. Here's the easiest kind of ways to do it. My website is up there as well, www.jabarnashassociates.com. Gives you a little bit of information on help. And other planners that are out there that want to figure out, how do I add this tax piece? One of the things we added recently that we didn't talk much about here is there's a new firm out there, Encore Estate Plans, that allows a financial planner like me to actually help my clients get their wills and trusts done. I'm not a lawyer. I don't practice law. I don't write the documents. They do that, but it's amazing the number of my clients that wouldn't go, even based on my advice. I would give them names of attorneys, wouldn't go to get their estate plans done. They just didn't want to go to an attorney and thought they charged too much. So now we're helping people get their estate plans done too. So there's a lot of ways that we can help people because of who we are and what we do. And so if there's planners, advisors out there who want to learn more about how I've set this up, feel free to reach out.
All right, awesome. And anybody that's listening on the podcast side, we'll make sure to have Jim's email, website, and phone number all in the show notes, so you can reach out to him there as well. And thank you so much, Jim, for sharing all this information and really helping more people understand the planning side of it, the tax planning side of it, and how they go together so well, and just really figuring out, which buckets you're putting your money in right now and how to really diversify that.
Well, I appreciate the opportunity, Hannah. It's very nice of you to provide this chance to enlighten people.
Yeah. Awesome. Thank you for joining us this week on the Virtual U.S. Financial Advisor podcast. Subscribe to the show on Apple Podcasts, Spotify, Stitcher, or via RSS so you'll never miss an episode. We'd love a rating on iTunes, or better yet, tell a friend about the show, which will help us grow as well. If you want to learn from any of our financial advisors, head over to our website, virtualusfinancialadvisor.com, to learn more about each financial advisor and connect with them personally. Be sure to tune in next week to get more advice from the expert financial advisors. See you on the next episode.